Welcome back, friends. Talks have stalled around the stimulus for the US consumers, and this is leading to a probable scenario where people will not be getting the stimulus checks, they will not be getting the benefits, COVID benefits that they were getting over the last few months, which has partly fueled the stock market rally in the United States. In the United Kingdom, there are now reports that the government is going to ask for quarantine of people returning from France for 14 days. This is in the backdrop of rising coronavirus cases in the United Kingdom and probable appearance of a coronavirus in what is being described as the second wave. Why do I believe that this markets could correct in the early part of this week is also related to the fact that the entire stock market rally is beginning to take the shape of a bubble in some form. Consider the evidence. The S&P 500 and NASDAQ are not far from record highs. The VIX volatility index has plunged in the last 1 month. And there is a crazy run for speculative stocks like Kodak. I mean, this is a photographic company, and apparently it is turned into a drug company now. And there is also a run for companies, bankrupt companies like Hertz, travel companies where the airlines are not even flying. There's a run for these companies. When there is so much of a disconnect between the real economy and the economy represented by Wall Street, there's growing evidence that correction is round the corner, friends. There's a surge in demand for unprofitable initial public offerings and special purpose acquisition corporations like DraftKings and Nikola going public through blank check mergers. All signs have been laid down, friends. The CNN Business Fear and Greed Index, which measures 7 indicators of investment sentiment, is not far away from extreme greed levels, friends. The Wall Street euphoria suggests that this could be another bubble or market mania. They don't tend to end well, as history has always shown. This is something which I have highlighted in the Art of Investing class, the program that I hold where people come on either Zoom or Google Meet and we discuss the future. I have explained that bubbles never end well. What history has shown and what can happen this time is something I'm trying to unravel for the participants in my Art of Investing program. If you would like to be a part, please feel free to WhatsApp me on 982-086-1044. There are growing concerns about the fact that stocks have continued to head higher even as the global economy remains mired in recession. Last weekend, we had peace being brokered between the UAE and Israel. And although peace is good for Wall Street, but Iran looks to be furious. And Iran is a major player in the oil market. There is every chance that Iran may up the ante this time. The job market in the United States is far from pre-pandemic levels, even though there are some gradual signs of improvement. The United Kingdom's economic slump is particularly painful, and the JP Morgan Chase CEO Jamie Dimon said recently that the market surge does not reflect the harsh economic reality which people are facing currently. And if my analysis goes right, I think this pain is only going to increase in the days and months ahead. We may see a little hope coming in over the next few weeks, and that makes me feel that this rally is not yet run out of steam. At the same time, it's not going to be a far distance when this rally, I believe, is going to reverse. The US labor conditions continues to show signs of stabilizing, but referring to it as being a healing is something which is a bit of a stretch, friends. The economic consequences of this level of unemployment has not been fully felt by the economy due to the significant transfer payments from the government, and that appears to be stalling in August. As the surge payments expire, the US economy will begin to feel the pain more acutely. It is also worth noting that earnings, to be blunt, have been terrible. That's to use the very somber word, I would say. Profits for companies in the S&P 500 plunged nearly 34% in the second quarter, according to FactSet. This was the worst drop in 5 years, and sales fell almost 9%, biggest decline in nearly 4 years. The earnings for the S&P 500 are now expected to fall nearly 19% this year compared to an anticipated drop of just 1.2% back in March. Add all this up and you have a market that appears to be overheated, according to Stifel head of institutional equity strategy, Barry Bannister. So I have one more friend who feels similarly, friends, and he wrote in a recent report that S&P 500 may be as much as 10% overvalued right now. The only difference I feel is there is still, in the very short run, there is some steam left. Yet, therefore, I also, however, believe that this market, global markets in general, will have a soft start to the week beginning 17 August 2020. Investors are definitely underestimating the risk of another surge in coronavirus cases, leading to more damage to the job market and earnings growth later this year. The 2021 earnings estimates are too high and will need to be revised downward substantially. For now, the tech stocks like Apple, Amazon and Microsoft have continued to propel the market higher thanks to strong earnings, and the work from home environment WFH has been particularly helpful. But that may not last forever, and even the quality companies can become too expensive. Valuations for the S&P 500 have been keeping us up at night. The recent run for tech stocks, especially the FANG stocks in the NASDAQ, is reminiscent of the dot-com bubble in the NASDAQ 20 years ago. Chinese consumers have all the eyes of the world set on them. Like just about everyone else around the world, they are now shopping more online and over their phones. This should be good news for homegrown e-commerce giants like Alibaba and JD.com, both of which are due to report their second quarter earnings shortly. One of their rivals, Pinduoduo, whose shares have more than doubled this year, will also release its latest results shortly. Shares of JD have soared 75% in 2020, while Alibaba's stock is up 20% year to date. The Chinese economy rebounded in the second quarter, following a sharp contraction in the first 3 months of the year as a result of the coronavirus, which is believed to have originated in Wuhan. One could forecast a nearly 30% increase in sales for JD from a year ago, while revenue is expected to surge almost 50% at Alibaba. While investors are cheering the comeback of the Chinese consumer and the broader economy, there are mounting worries that Alibaba could become the next target of President Donald Trump's war against Chinese tech companies. United States has already announced crackdowns on TikTok, the popular social media app owned by China's ByteDance, as well as a ban on Tencent's WeChat. And now the US Securities and Exchange Commission, or SEC as it is popularly called, is looking into Baidu's video streaming unit, IQIYI, for alleged fraud. Trump wants ByteDance to sell the US assets of TikTok. Microsoft has confirmed that it has discussed it with the president, and that there are also rumors that Twitter may be interested in a deal as well. To cut the long story short, there is a likelihood that the stimulus could be delayed even further. And the most important thing that is now wearing down on the sentiment after you find that most global indices are nearing their all-time highs is the fact that the unemployment levels have not reduced in many parts of the world, and at the same time you still feel that there is a possibility of a second wave of coronavirus appearing in many parts of the world, particularly the United Kingdom and United States, most important economies that you can have a look at. The scenario looks to be rather bleak, and something that really is reminiscent of a scenario where the real economy is not doing well, but the stock markets are. And one can definitely say that this is a scenario which is all setting up for a major correction sometime later on this year. But even in the short run, situation is such that the surge payments in the United States are due to expire. The US economy will begin to feel the pain acutely, and you will find that unemployment has truly not been fully factored into the earnings so far. The surge payments have come to provide some relief, but as the stocks stall around trying to bail out the economy, you will find that the story changes, and once again you will find that the economy could take another knock. The retail consumption of the consumers, which was beginning to look like returning to pre-pandemic levels, could get another knock. The unemployment levels could start rising once again. Job losses could increase. This inability to be able to generate further surge payments to the US citizens, coupled with the fact that pandemic cases seem to be in a sort of a second wave across the world, are going to be the leading causes. To cut the long story short, we should probably be seeing a tepid start and a correction in global stock markets in the early part of the week, beginning August 17, 2020. Happy investing. Take care.